Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in our last video we talked about 6 different companies that are in my portfolio that are performing really well so far. In today's video we're going to do the opposite. So those were the winners. Today we're going to talk about the losers, the companies that are not doing so well. But if you haven't joined us on the Patreon account yet, please do so. It does help the channel, of course, and if you haven't liked the video, please do so as well. So what we're going to do is we're going to talk about 5 different companies that in my portfolio that have not done well so far. I'm going to give you exactly what I'm going to do with them at the end of the video, so stay tuned for that. This is my current portfolio, if I can speak, portfolio, and as you can see is £94,451 right now. And my plan, inshallah, is just to carry on investing in this portfolio until the end of this basically year. So not the end of the year, until basically financial year, which is April. After that, I'm not going to put any more money into this ISA account. I'm looking for a new platform, inshallah, to move to, and then I'm going to let this basically portfolio just carry on as it is. So any money that comes in from dividends and so on, I can just reinvest in that within the portfolio, but I'm just going to keep the portfolio and let it be. So that's the plan, inshallah. I'll give you more information as we go along to basically towards the end of towards April. But for now, let's get started on the 5 companies that I want to share with you guys today. Right, so the first one is UNIL. There's no surprise, you know, this company has not done well since the beginning of the year. Not beginning of the year, since almost 2 years now. I've had this company since 12th of May 2020. So 2020, when I started this portfolio, I think it was the first week of May. Straight away, this company was one of the companies I actually added to the portfolio. Why? Because I actually understand their business. It is easy to understand, to get my head around. I buy their product all the time. You know, wherever you are in the world, you buy their product every single day without even thinking about it every time you go to the supermarket. And for that reason, I decided to add to the portfolio. The company right now has a market cap of $122 billion. It has a wide economic moat, currently trading about $49 US. Dividend yield of 3.82 right now. The payout ratio is 63%. Latest increase was not there. So if you look at the dividend max, is slightly different to what's in basically reported in Simply Safe dividend. But I'm going to use, for the sake of this video, I'm going to use the Simply Safe dividend information. And according to them is -4%. The 5-year growth rate of 3% and dividend streak of 28 years. Annual dividend is $1.91. Safety 75%. Profit margin of 13%. Return on equity 41%. And return on invested capital basically and 17%. So when you look at this side of things, it's actually not bad at all. Free cash flow of $6.4 billion US. Total return right now we're looking about 6% in the last 10 years. Growth estimate for the next year, I couldn't find it on Yahoo Finance. Growth estimate for the next 5 years though is about 5%. Which is basically decent for this company because that's what they normally report every single year. 12% discounted right now according to Morningstar. $56 per share is where they think the price should be. And looking at Yahoo and Seeking Alpha right now, for the 1 year you can see it's 2% down. Year to date is about 1% up. If we go to earnings and click estimates, you will see, I think they're reporting soon, by the way. I think, yes, basically the 8th of this month. So we'll see what they say. And as you can see, it's about 2.86%, 9% for the next 3 years in terms of EPS. And in terms of revenue side of it, basically this year, I think they've got one more quarter to report. And then after that's flat. So 2.54%, 3.4%, 3.4% is actually, this is basically what this company does year in, year out anyway. I'll tell you exactly what I'm going to do with the company at the end of the video, like I said. The next one is AstraZeneca, another UK-based company. This one is actually quite new. It was April of last year that I started investing in this company. $203 billion market cap right now. It has a wide economic moat, $65 per share right now. Dividend yield of 2.3%, which is quite nice. Payout ratio 40%. Latest increase 1%. 5-year growth rate of 1% as well. Again, this comes from Simply Safe dividend. If you check dividend max, which you can actually use for UK companies, it is slightly different. Dividend streak of 2 years in a row. Annual payout $1.42. Safety 70%. Profit margin 13%. Return on equity 16%. And return on invested capital 20%. They have almost $7 billion right now in the bank. Total return in the last 10 years about 10%. Growth estimate for next year 14%. 13% after that for every single year. 16% discounted, $78 per share is where the price should be. This is one of my favorite companies right now. I'm still buying. I will continue to buy this company. No issues with the company, but it's down a little bit, so I will take advantage of that. I'll show you exactly how much I'm down on each one of these companies. The next one is Public Storage. But before we do that, let's go to Seeking Alpha to check AstraZeneca earnings reports. And as you can see, if you look at the estimates, 10%, 14%, 20% and 24%. So even if you just focus on the first two, double-digit growth in terms of for the next end of this year and as well as the next 2 years, which is quite nice. 3%, 10%, 7%, 5%, and in terms of revenue side of things, so no issues there, no concerns from that side of things. In fact, I can show you the ratings as well. It's a strong buy from Wall Street, and as you can see here, okay, there's about 23% upside from now. $80 per share is where they think the price should be. Right now, as you can see, is about 65. So in terms of Wall Street, they think it's actually quite a strong buy, as well as Seeking Alpha. They are also saying basically three of them that basically saying is a buy. But when you look at Wall Street, it's about 8 people that are saying a strong buy, 5 buys from also from Wall Street. Right, next one is Public Storage. This company I started, I think, in June 2022. It has a 49 billion market cap right now. Is one of the only REITs that I own in this portfolio. It has no economic moat at the moment. Price is $280 per share. Dividend yield of 4.28%, which is quite nice. Payout ratio is 78%. Normally, when it comes to REITs, you're looking about 90%, below 90%. Latest increase is 50%. 5-year growth rate of 0. Dividend streak of 0. Annual payout $12 per share. Safety 96%, profit margin 43%, return on equity 21%, and return on invested capital of 12%. Almost $2.7 billion of free cash flow right now, 9% growth in the last 10 years. They're expecting the earnings to decline 3% this year and then 20% after that. Fairly valid at the moment. $317 per share is where they think the price should be. Now, if we check Seeking Alpha, if we go to earnings estimates, what you will see is about 5%, 1%, 3%, 3%, 5%, and so on. And then in terms of revenue, in terms of, this is the FFO, by the way. This is a revenue side of things, so 7%, 4%, 5%, 5%, and so on. So nothing really too huge to worry about. And looking at right now, everyone basically, including Quants, is actually saying is a buy. So Wall Street is actually got buy rating of $311 per share, 11% upside from where we are. And Quants is actually also saying is a buy, as well as the Seeking Alpha analyst there. Right, so that's the third company. The fourth company we are looking at today is UPS. UPS actually just reported a couple of days ago, and it went down quite a bit. So I'll tell you exactly what I'm going to do with the company in a second. But I started buying this in March of 2021. And since then, I've been just dollar cost averaging into this company. It has $121 billion of market cap. Wide economic moat, $141 per share. Dividend yield over 4.6%, which is quite high right now. In fact, is the highest on this list so far that we have seen. Payout ratio 73%, very, very high. I hope that comes down in the next couple of quarters. Latest increase was 1%, 5-year growth rate of 13%, dividend streak of 13 years in a row. Annual payout $6.52, almost to 70% in terms of safety. Profit margin 7%. Return on equity of 36%, and return on invested capital of 20%. $5.5 billion of free cash flow right now, which is quite nice. Total return in the last 10 years 7%. 17% expected to grow the earnings about 17%. Then after that, decline of 6%. Fairly value right now, $159 per share is where the price should be according to Morningstar. Now, looking at earnings of this company, if we go to the earnings estimates for the next year, so 2024, a decline of 5%, then 18% bounce back, and then 7%, 13%, 21%. So it's only this year that they is basically reporting doom and gloom. After that, 30 of them basically agreed that the company should be fine and should bounce back about 18.5%, which is quite nice. And looking at the revenue side of things, okay, about 2%, 2 and something percent, 5%, 2 something percent. So again, nothing huge to worry about. I'm definitely not worried about this company. When we look at the ratings, as you can see, Seeking Alpha Analyst is saying it's a buy. So 6 buys here. Wall Street is saying about 11 of them are saying it's a strong buy, 1 buy, 17 hold, 1 sell, and 1 strong sell. So nothing really huge to worry about in terms of even what the analysts are thinking of this company moving forward. I'll tell you exactly what I'm going to do at the end. And finally, I'm sure you've seen this one, talk about this one for a long time. I bought it July of 2020. 3M is one of the companies that has been down for a long time. It has 52 billion market cap right now. It has a narrow economic mode. Price right now is $94 per share. My average is over 140 US dollars or whatever it is. Dividend yield of 6.6%, which is absolutely huge. Payout ratio 65%. Not bad considering. Okay, the dividend yield right now, latest increase was 1%. They have been increasing just to keep that dividend king status. They have been increasing by 1%. The last 5 years though is only 2%. And when you look at the dividend streak of 64 years in a row, so they have increased that dividend for 64 years in a row. Annual payout $6 right now. Safety 40%. So this is the bit that's worrying a little bit, because the safety is actually quite important, and I'll show you exactly what it looks like in terms of the free cash flow. As you can see, is actually not bad, but the safety side of it is actually quite low right now. Profit margin minus 21%, return on equity minus 71%, return on invested capital minus 43%, which is ridiculous. Free cash flow right now 4.8%, total return in the last 10 years 1%. Growth estimate for the next year is 7%. Then they expected 4% after that, 23% discounted, $124 per share is where they think the price should be, and that's 3M. Now, this company, I've said it from day one, I've been saying this for quite some time. I'm definitely going to sell it as soon as it bounces back, and I'll show you exactly in terms of what the analysts are saying about this company. But before we do that, let's go to the earnings estimates for this company. You can see 4%, 7%, 6%, 3%. Not bad at all when you look at it this way. So even if you just focus on the first 3, 4%, 7%, and 6.5%, 6 something percent, that's okay. Now, in terms of the revenue side of it, there's a decline, and then 3%, and then 5%. Now, the issue with this company is not even the earnings, the fact that it's flat, it hasn't done anything for the last God knows how many years. Okay, even if you look at the last 5 years, it's down 52% in the last 5 years. In the last 10 years, it's down 27%. No matter how low the PE is, this is why you people need to be really careful with buying stocks that will have a very low PE, because people think, oh, it's very cheap. But the outlook does not look great, and my concern with this company is all the issues that's happening with basically the legal side of things that's happening. So you got a lot of people, look at that, major lawsuit damage shareholder value, which is quite important because they pay in billions of dollars to settle this situation that's going on. For that reason, I'm definitely going to sell it. Now, let me show you exactly how much of these companies that I own. Right now, with this one, I'm down 32% or £1,443 down right now. That's huge, and this is my biggest loss so far. So I'm gonna hold on to it because look at that, $144 per share is basically where my average price is right now, is $94 per share. It hit about, I think not long ago, I think it was around 120 February of this year, last year. And then since then it has been just going down. It was, the lowest was 85, and then it bounced back, and then again down again. So what I'm going to do is I'm going to hold on to it for a bit, okay, for maybe until summer, maybe end of this year, and then possibly sell it and take that money and put it into something else. I might decide to get rid of it before then, see what happens. Like I said, AstraZeneca was there, another one, only 7% down, £242. I'm not worried about it. I will buy more of this company. The next one that I want to show you, by the way, please be mindful. Last time we did a video like this, Medtronic was one of the companies. I was down quite a bit. Right now, I'm only down 2.7%. It has bounced back. Okay, so these things can happen as long as the fundamentals of the business is still intact. Everything is okay. There's no legal situations or anything like that. you will be okay. You just need to let it be, collect that dividend, and enjoy your life. But right now, 3M is not basically, I don't get that feeling. AstraZeneca, I have nothing to worry about. I will be buying more of that company. The next one is Public Storage. Again, only 4%, 4.5%, 5%, whatever it is. £240 down right now. And finally, UPS, which is down £941. Again, I'm buying more of this company. I'm buying more Unilever. No, I'm not buying more Unilever. I'm buying more UPS and Unilever. At some point the next few weeks, I'm definitely going to sell it. And the reason I want to sell it is nothing to do with the fact that it's down so much. It's a lot to do with the growth is almost dead. The dividend is okay. And the fact that the Ben & Jerry situation with the basically what's happening with the Israeli government and Zionists, basically what is happening in Palestine, I am definitely not comfortable with that. I've been waiting for quite some time just to break even so I can sell it. But until either if they settle the situation with Ben & Jerry's, then possibly look into it and then see what the outcome is. Otherwise, I'm just definitely going to sell it because I don't feel comfortable holding it right now. Anyway, that is the companies that I want to share with you guys. And final thing I want to show you guys is the Sharia compliance side of things. All of these companies are fine in terms of Sharia compliance side of things, but please be mindful, please be careful with 3M and all the other companies, because they're down, it doesn't mean it's just to go away and buy them. I'm just buying them because I feel like some of them, especially these three here, I'm comfortable buying more of. Okay, these two right now, absolutely no chance. Okay, so inshallah, I'll let you know. As always, I'll update you. I will keep you basically updated as always. So please be mindful. I'm just sharing my journey. This is not financial advice. Just like you see, I might sell this and lose about over £1,400 just like that. Okay, so just be mindful. Have a wonderful day. Assalamu alaikum.